So we have come up to the next topic that is one of the most important topics within the risk management, which is market risk management. Therefore, because you know that usual banks or companies, they have some kind of the market portfolios on their balance sheet. Why? Because banks, for example, they need so-called liquidity buffer. And they usually invest in, for example, the sovereign bonds, sovereign fixed incomes. Those are very liquid usually. And also they have to diversify their assets, and therefore they may invest even in equities. And some time ago, a few years ago, for example, maybe 10 or 15 or 20 years ago, it was very usual thing that banks invested in equities, for example, in terms to gain some benefit, some profits. Therefore, it's not very usual nowadays. For example, banks, not investment banks, but usual commercial banks, they usually prefer not to invest in the equities directly, at least, but they prefer to invest in fixed incomes. And nevertheless, these kind of instruments, they bring market risk to the bank, for example, as well. And a common, for example, industrial company or producing company, it may have equities, liquid market equities on the balance sheet as well, for the same purposes, to diversify their assets, for example. We do not talk here about the private equity holdings, actually, when, for example, a holding company has equities of some legal entity, for example, on the balance sheet, which is privately held, because this is not actually about the market risk management. You should understand. This is more about the credit risk, or because they depend on the possible bankruptcy of that legal entity. And this is more about the balance sheet management, balance sheet risk management, which will be considered afterwards a little bit further. So let's go on. Let's start with the market risk factors and sensitivities, which is commonly called GRICS. Let us understand what is the market risk, first of all. First of all, market risk is the potential for loss due to changes in market factors, like, for example, interest rates, exchange rates, and asset prices. And it is usually important to understand that market risk manifests differently in the trading book versus the banking book. So remember what I said to you before. So a company may have, for example, equity on the balance sheet, but it might be not treated with the market risk management because it's a privately held equity. So therefore, there is a difference between trading book and banking book of the banking book is usual for the banking for sure. But if we talk about the company, then it will be not a banking book, it will be a balance sheet or balance book, I would say. So nevertheless, in the trading book, market risk arises from active trading activities usually. And for banks, it comes from normal banking operations like loans and deposits. And the key difference here is the intentionality. Like, for example, traders actively take on market risk to generate profits, while banks, for example, or banking departments who issue loans and acquire deposits, they try to minimize it. Let's consider a real-world example of that. Let's consider a bank that offers, for example, fixed-rate mortgages. If interest rate rise, the bank faces market risk because the value of the mortgage declines. And this isn't from the trading activity, actually. It's from the core banking operations. Because of that, it's the market risk within the banking book or within the balance sheet. So there are different market risk originations. Let's break down the components of trading positions then. Because understanding this is very crucial for grasping how market risk manifests in real trading scenarios. For example, first we have different ways of trading. Yeah, on the exchanges, everything is standardized, as you know, and think about stock exchanges, for example, and over the counter or OTC. Terms are usually negotiated between the parties. And on the other hand, this flexibility in OTC markets can lead to unique risk profiles and maybe very complex to evaluate on. And next, the calculation methods vary. Some instruments, for example, are settled in cash. Others may involve physical delivery of assets. If you talk about the so-called derivatives, this, in terms from the standpoint of view of the risk management and risk evaluation, this impacts for sure how we measure and manage risk. And it may depend also on the complexity of instruments, which those may range from basic, like buying a stock, for example, to derivatives like options. And derivatives usually derive their value from an underlying asset. And this also may add layers of complexity to risk management, for example. And we may also have various tools like securities, interest rates, currencies, commodities, and more. And each category of the above mentioned, they may have their own risk characteristics. So I see. Okay. I thought that was a question in the chat. So let's go on. Then let's examine the different risk components in the corporate bond, for example, is one of the examples of the market risk asset. So here on the graph, we have an example of the automaker with the BBB rating, for example. The foundation here is the benchmark yield, typically based on the swap rate for that currency and maturity. And this usually represents the general interest rate risk. Yeah, as interest rate risk is a part of the market risk overall. Then we can see, for example, the sector-specific spread. And in this case, for example, for the automobile industry, this usually captures broader credit risk for the sector. So credit risk is usually not a part of the market risk, but it's one of the components of the trading instruments. But in some cases, and we will observe it further, credit risk may be a part of the market risk, and in that case, it may be called the counterparty risk, for example. Yeah, or the market credit risk. There is a case. And then, as you can see, there is an obligor specific spread, which reflects usually the unique credit spread for this particular company. So we have general market risk, and we have company-specific risk spread or risk. And we have to notice here that the yield can change due to the various factors. For example, general interest rate movements, smooth credit spread changes, or even sudden jumps from the rating changes or default. all of these factors may influence strongly the yield of the fixed income and the price for the fixed income as well, for sure. We can derive these spreads, for example, even for the equity, but they may differ from the fixed income profile for sure. For example, there may be the much higher level of the general risk influence on the equity price, but there may be, for example, much less spread for the credit risk. Yeah. And generally speaking, this breakdown helps us to understand and to manage different risk components. And for instance, we will observe the incremental risk charge, or IRC. Later on, it may focus in that sense on those credit spread jumps and default risk only, not on general market risk. But deriving these market risk components out of the or market risk spreads out of the instrument profile, fixed income profile, for example, may help us to manage and to hedge market risk of the instrument more precisely and more consciously. So let us go on with the components of the market risk. Let's dive into the nitty-gritty of capital calculation here. We can start, for example, with the general market risk, as it was mentioned above. And this is our broad systematic risk that affects all market participants, usually, not just only the only company or the only equity or the only fixed income, but all market participants on the same circumstances, conditions. For example, general market risk may be related to the interest rates, foreign currency rates, for example, or major equity indices, market-wide. Yeah, market-wide equity indices usually demonstrate the level or the dynamics of the general market risk, not a specific equity. Then we have specific, usually we have specific market risk. There's where we may zoom on an individual securities. For example, for bonds, it might be credit spread risk, and for equities, it could be company-specific factor. And here's where it gets interesting. For example, as it was mentioned, the incremental risk charge, or IRC, it may be the new, relatively new addition, and it's all about capturing those risks that value at risk might miss, like credit, for example, migration, and default risk as well. For example, we can remember the crisis, one of the crises, for example, 2008 financial crisis, and where many banks were caught off guard by the rapid deterioration of seemingly safe securities, even safe securities. And here, the IRC, incremental risk charge, has been designed actually to address exactly this kind of risk that is under stress. And we can also have, for example, an equity event charge. And this is about capturing those sudden, sharp movements in equity prices. Those can happen, for example, due to specific events. I don't know, the change of the management, the death of the founder of the company, I don't know, many things. Those may not be quantified usually, but they for sure influence the equity price. And what about the stressed value at risk? We'll talk about this later. And but we usually say about this, what would our value at risk look like under really bad market conditions? So this is about the stress testing and the value at risk calculation. And lastly, we may have the security framework charge, for example. This is honestly, this is a bit of a catch-all for risks that might not fit neatly into the other categories. But it it makes sense to take into account this kind of charge usually. And we have to note to sum up that this market risk capital is not just one number, it's a composite of various risk factors usually. And each of these risk factors usually captures a different aspect of market behavior. It's complex usually, but the complexity is necessary here to truly understand and prepare for market risks, as I understand. So the next slide is market risk quantification within a bank. Here, we can dive into how banks actually quantify market risk for capital purposes. And usually this formula might look complex, but let's break it down step by step. So the core of our calculation is usually based on the value at risk. Yeah. And for that purpose, we usually use historical simulation. For example, over a 2-year period of time, looking at a 10-day horizon with a, for example, 99% of the confidence interval. Here, we can calculate separate value at risk components for forex risk, interest rate risk, and price risk. And each of these components usually get multiplied by the factor of 3 or 4 plus, which is called an add-on based on the backtesting results. So don't worry, we will go through all of these definitions later on. It's just an overview of them, of the approaches. So there might be a question actually, why the factor 3 or 4? Yeah, what is it for in terms of the calculation of the economic capital? Actually, this is usually a regulatory requirement to account for the model risk and potential extreme events. So it's true that in regulation, in international regulation, even it might be recommended by the Basel Committee not to make the calculations extremely difficult, extremely complex. So usual regulator just sets up a definite parameter of the calculation, for example, which may be derived from the backtesting, from the general market overview, or even hypothesis, just to test it out. But there might be many struggles, for example, between the banks and regulator for this figure as plus factor, because it directly influences the possibility, the bank capacity, for example, to allocate their capital into the assets, yeah, and to drive their businesses, to increase their assets, to increase, to spread out their loan portfolios, for example. And here, high plus factor due to the poor backtesting can significantly increase capital requirements. For example, for interest rate risk, we may look, for example, at the change of the net present value from a parallel shift of the yield curve. So here's a market risk embedded into the interest rate risk. And this approach generally assumes risks can be aggregated linearly. But in reality, you should take it into account actually that there can be complex interactions between risk factors, and especially in stressed markets. So I see some messages. Just a sec. What is CAR? Yeah, sorry. It's capital at risk. Capital at risk is the value of the economic capital actually derived from the value at risk by means of multiplying it by the plus factor. Yeah, and economic capital is it is useful, for example, in managing the so-called. Do you remember the ratio between the relationship between the economic capital and the available financial resources? So it's usually useful for understanding what value of the lending capacity, for example, we have, or what driving business capacity a bank has, for example, in terms of the capital adequacy limitation. No capital adequacy ratio. It's capital at risk. Yeah, capital at risk. Yeah. Thank you for your questions. Let's go on. So the next slide is risk identification process. And let's dive into it, actually. So here, the first step is to divide our portfolio by asset types, as you can see on the slide. This, on the one hand, it might seem straightforward, but in complex portfolios, usually it requires careful analysis. We are essentially creating a map of our risk exposures, starting to evaluate the market risks of this portfolio. So we usually start from the decomposition or cascading of its risk factors influencing this equity or in this portfolio. Okay, let's go on and let us then we will have to determine the specific risk factors for each asset type in our portfolio. This is usually crucial because it allows us to understand what market movements will impact our portfolio. And if you look at the diagram here, or graph, so we've broken down a portfolio into fixed income, commodities, forex rates, equities, and the others. And each of these factors has specific risks associated with them. Actually, that is why it makes sense breaking down this portfolio into risk factors, because the evaluation methods or approaches, risk factors, risk components for all of these factors are different, and they're treated differently, actually, and they are they are being managed differently as well. Here is, for example, a fixed income. We are looking, we may be looking, for example, for a credit spread and interest rate risk. While in forex or rates, we are concerned about the interest rates preliminary and forex movements, for example, preferably. Sorry. And even, for example, in equity prices for some products. In general, this process is really a foundation of all our risk management efforts. Yeah, it's like, in other words, it's like creating a detailed blueprint or a building before starting construction. And for sure, without this step, we would be flying blind in our risk management efforts, actually. That is why it is important. So let's proceed on the risk factors example. So here, risk identification is carried out by identifying and assigning portfolio positions to specific risk factors. And what is the risk identification process? As for example, so we are not just categorizing these factors for the sake of it. Each risk factor here represents a specific way the market movements can impact our portfolio. Therefore, by mapping out our positions to these factors, we may create a framework for measuring and managing our risks. For example, let's take our forex rates sub-portfolio, yeah, as an example. For example, we've identified three key risk factors here, like interest rate risk, currency risk, for example, equity risk. It might be surprising, actually, why equity risk is in the Forex portfolio. Well, but some Forex products, like, for example, Quanta options, do have exposure to equity markets, actually. And don't forget that, for example, derivatives like options, equity options, they also are being influenced by the equity prices as it is an underlying asset of the option. Yeah. Overall, this granular approach may allow us to see how different market movements might impact our portfolio. For example, if interest rates spike, we know exactly which positions will be affected and how. So that makes sense. Just in general, to make you aware, let's talk about the other component of the market risk, which may be called wrong right weight risk. So it's a very specific one. It does not relate actually to all of the common banking operations in the trading portfolio, but only to preliminary, preferably to the counterparty risk, which will be observed within the credit risk management, actually. Just to let you know, wrong way risk. So this is when the risk of a counterparty actually defaulting, and it increases our exposure to them, to the position in the trading book. That is why I've been talking about that. So the distinguish here may be of two types: specific wrong way risk and general wrong way risk. Specific wrong way risk is usually tied to the particular transaction structure, while general wrong way risk is related to broader macroeconomic factors, usually. For example, what is an example of the specific wrong way risk? It's, for example, buy and default insurance, like credit default swap, which may be one of the part of the trading portfolio. So if you buy this kind of default insurance from the very company, so you are insuring against the default of the equity emittent, for example, equity company. If they default, your insurance is worthless when it's needed, for example, most of all. But for the general runway risk, think about, for example, buying a USD to ruble swap, for example, from a Russian company. If the ruble weakens, the company credit quality might deteriorate just as our exposure increases. That is about the general runway risk. Usually, quantifying runway risk requires you both a quantitative analysis and qualitative judgments as well. And just looking about it is about looking for the connections between the counterparty default risk and the underlying risk factors and the underlying value, which usually is connected to the counterparty. So let's go on. So let's go through the sensitivity indicators measures, and let's consider how the changes influence the value of the instruments in the trading book, for example. First of all, while we have identified our risk factors, we need to quantify how sensitive our positions, for example, are to changes in these factors. Yeah, the next step. And this is where sensitivity indicators come in. Usually, these indicators tell us how much the value of our instruments changes when there is a small shift in the risk factor. They are, in other words, they are like the nerve endings of our portfolio, telling us, for example, where we are most sensitive to the market movements. For example, if we look at the two key examples, like DVO1 or CSO1, yeah, a DVO1 usually measures the dollar value change for 1 basis point shift in interest rates. So the dollar value change of the instrument in our portfolio. If the yield curve shifts, for example, just for 1 basis point. 1 basis point is there are 100 basis point in 1%. So on the other hand, the CS1 does the same for the credit spreads. So what is the value? It shows what is the value change in our for example, equity or fixed income on our portfolio, if the credit spread in the market changes for 1 basis point. Let us give an example here. For instance, if a bond has a DVO1, say $1,000, then it might mean that its value will change by $1,000 for every 0.01% or 1 basis point change in interest rates. Yeah. This might not sound like much, but for a large portfolio, it can add up to millions, for example. And yeah, and just to sum up, what is the benefit of using sensitivity indicators? So they actually allow you or a risk manager to calculate the possible or to make possible forecast of the value change of the portfolio very briefly, very quickly, but not very precisely for sure. So you just multiply the change in the risk factor, for example, by the sensitivity ratio, and you derive the change in the value, the projected change in the value of your portfolio, for example. So that is very convenient. That is very comfortable for the risk manager, but the trade-off is preciseness of the calculations. Then let us overview options Greeks as one of the examples, very strict examples of the sensitivity measures, sensitivity ratios in terms of the management of the market risk. So these are sensitivity measures specific to options, first of all, and they are named after Greek letters. So that is why they are Greeks. Yeah, but don't worry, for sure, we do not need to understand Greek or to speak Greek to understand that. So first of all, delta is the heavy hitter here. Usually, it tells us how much an options price will change for $1, for example, move in the underlying asset. And a delta for 0.5, for example, means that the option price will move $0.5 for every $1 move in the underlying value. So the next Greek is gamma. So that is a delta sidekick actually, and it measures how fast delta changes. Yeah, it's a second level derivative from the delta. In this case, high gamma positions can see their risk profile change rapidly, and that can be both a blessing and a curse, for example. The next one is Vega, which tells us usually about volatility sensitivity. If, for example, Vega is high, then a small change in implied volatility of the option can have, for example, a big impact on the options price. The next one is theta, which is all about time decay. actually. It's usually negative for buyers and positive for sellers of the instrument, and it's why they say time is money in option trading specifically. Then there are several others Greeks, so there are many of them to be conscious. So, and well, for example, RAW. So there's another Greek, which measures sensitivity to interest rates. It's often overlooked, but in times of changing rates, it can be crucial. That is why it is omitted here in the list of the Greeks. So it is not useful usually. And there are also so-called the second order Greeks. For example, Vanna or Volga. So these are they are more complex, but we will not consider them very in details. But they may become very important, for example, in case of the some kind of sophisticated option strategies, for example. Yeah. And this is a very famous Black-Scholes formula, which is very important in terms of the valuation of options, in terms of the derivatives, especially options, market risk management. So, actually, this equation, which you can see on the screen, revolutionized option pricing and earned its creators a Nobel Prize even. So we won't derive it from the scratch. Actually, it is not very complex, but not very simple. On the other hand, but let's break down this formula into the components. For example, S here, as you can see, is the current stock price. K is the strike price of the option. R is the risk-free rate. T is the time to maturity. Sigma is volatility, usually. And in general, these inputs determine the theoretical price of European-style option. So the left part of the equation here represents the expected benefit from buying the stock, while the right part is the present value of paying the strike price, usually. And here, the components like ND1 and ND2, as you can see, are usually cumulative normal distribution functions. And we can think about them like, for example, probabilities. Yeah. And usually ND1 value may be treated as a delta of the call option, for example. Usually, this formula assumes that stock prices follow the log normal distribution. But in reality, in real market, markets can have usually, or the distribution of the prices for the equities may have so-called fat tails. Fat tails, which means the extreme events, meaning extreme events happen more often than this model predicts. And this is why we need to be very cautious when relying solely on Black-Scholes. And this is one of the problems of this model. So this model is some kind of the theoretical one. Okay. This slide may be looking intimidating, but it's actually a gold mine of information, actually. So what we are looking at the partial derivatives of the Black-Scholes formula. In other words, the Greeks we discussed earlier. Each box in this grid represents how the option price or one of the Greeks changes with respect to the change of one of the input variables. Like, for example, it's like a roadmap of option sensitivity. For example, here, the top row shows how the option price changes with respect to each input. This gives us delta, vega, theta, and draw, as you can see here. Then the second draw is about how delta changes. So this gives us gamma, vanna, and charm. So gamma, as we discussed earlier, is particularly important for understanding how our risk exposure can change rapidly. Yeah. The third row focuses preferably on changes in gamma, giving us speed, soma, and color. So these actually higher order Greeks are less commonly used, much less commonly used, but they become crucial in complex option strategies, for example, on in highly volatile markets. These Greeks usually give us very valuable information, and they're usually based on the assumptions of the Black-Scholes model. And what does it mean? That means that in extreme market conditions, reality might diverge differently, significantly differently from what these measures predict, for example. So the next model we will briefly go through is a Taylor series. It is very applicable, actually. It is very useful within risk management. That is why we have to observe it very briefly. So the Taylor series usually is a way to approximate a function around a certain point in mathematics. But in risk management, we use it to estimate how the value of our portfolio will change as market factors move. In general sense, not only connected to the Greeks, to options, for example, but for fixed incomes, even for equities. Okay, if we look at the second equation here, it shows that the change in market-to-market P&L can be, for example, approximately by the first derivative delta times the change in the underlying plus half the second derivative gamma. So which times the square of the change. So this is a formula, and this is really very powerful stuff. It means that we can estimate our P&L, profit and loss, for small moves in the underlying without having to price heavy instruments in our portfolio. And it is very good. It is really good for the very brief evaluations of the risks within our portfolio. And in practice, we often stop at the second order and gamma of this formula for most of the purposes, I will say. They're higher, really. In reality, they're higher orders, but they become important for very large moves, for example, of highly nonlinear instruments like some exotic options. So we can use the higher order parts of the formula, but initially it is very long one. And we should remember here that as usually it is just an approximation, it is just a model. And therefore, for example, for large market moves or for complex instruments, you might usually need to include higher order terms or use full revaluation of your portfolio. I would say that according to my experience, risk managers prefer to perform the full revaluation of the portfolio instead of using this formula because it has actually limitations. So this formula actually may usually used just for the brief estimation of the possible change of the portfolio or one instrument within the portfolio. Okay, let's go on with the Taylor series and let's apply it to the different asset classes, for example, how it works. Let us understand how it works. For example, for fixed income, we usually use DV01, or as you remember, dollar value for 1 basis point instead of delta, like for the options. And usually it represents how much the price changes for a 1 basis point move in yield curve. in parallel shift, to be precise, of the yield curve. Here for equities and commodities, we stick with the familiar delta and gamma usually, and this usually tells us how the value changes with respect to the price movements. Options actually are where it gets really interesting because it's much more complex instrument. Here we may include Vega, sensitivity to volatility changes, and theta for sure, for example, time decay, as you may remember, in addition to delta and gamma. And this usually reflects the complex nature of option pricing. So let's go on. Just a second. Sorry. I'll look it up. So we have to have a break now for 10 minutes. So sorry, I remember that. So let's make a break, for example, say until 15 until 15:05. Yeah, until 5 minutes after 15, if you don't mind, for 10 minutes. Okay, let's go on. Do you see slides? Do you hear me well? Please write down in the chat. Yeah, sure. Thank you. So let's go on. And now let's zoom in on the gamma behavior. So as you can see here, the slide shows us how gamma changes with respect to time, to expiration, and volatility. And it's a key insight actually for understanding option risk dynamics. First, for example, we can look at the gamma, like gamma behaves as we approach expiration. Yeah, expiration of the option. You can see that it starts relatively flat, and when we are far from expiration, but as we get closer, it spikes dramatically for the money options. And this is why gamma risk can explode near expiration, for example. And now let us look how on the right graph, how the volatility affects gamma. So high volatility flattens the gamma curve, spreading the risk over a wider range of underlying prices, and lower volatility concentrates gamma risk, usually. This is actually, these are very important implications for risk management. Why? Because in low volatility environments, your gamma risk is usually concentrated, which makes you more sensible to small moves around the strike price, for example. And in high volatility environments, your risk is not more spread out, I would say. This is very important to understand that. Okay, let's get to the market risk management overview. But before we do that, let's make some kind of the warm up. I will provide you with a case, which is supported by the materials of the previous lecture, actually the first one, and there will be some quiz based on the case. So let's try to perform it. And then afterwards, we will move to the next topic devoted to the market risk management. Just give me a couple of seconds. I will send you the case description to the chat just right away. And I will provide you with a link to the questionnaire based on the case. Okay, please tell me, are you able to download the case description? Can you enter the link provided? Do you see the questionnaire? Yeah, sure. Yeah, thank you very much. So please go through the case, read it very carefully. Let's take for about, say, 10 minutes for that. And then you will have to provide your answers for the for 5 questions in the Yandex form. Let's take for about, say, 5 minutes for that. So they are not very complex. or 10 minutes, I don't know. Let's provide 5 minutes. And then we will discuss the results all together. Yeah, what is a group email address? So please tell me, do you have any email address, for example, for the group messages? Those relate to all of the members of the group, of your group. Or maybe, no. It's a pity. Telegram chat. So actually I need this group email address just to identify different groups in the questionnaire. So it's not critical. Then do you have do you have okay, let us do the following. You can write down your high school of economics address if you have one, for example, in this field, and I will be able to identify you through the list of the group afterwards. Please put on your high school of economics address here. So let's start. You have 10 minutes for the case reading and 5 minutes for answering the questions. Let's continue after 15 and 30 then. If you have any questions, misunderstanding, for example, not hesitate to write it in the chat. I will reply very briefly. All the questions and all the answers are based on the materials learned before during the first lecture. And by the way, this questionnaire is not evaluated, actually. It will not influence your final mark. It just warm up to show you the process, to get you aware of the process. But the next questionnaires will be evaluated. They will influence actually your final mark, final grade. Okay, let's get back. I see your answers actually, so everybody's ready. Since this execution is not being evaluated actually, so we can we do not have to wait for the others who have not managed to answer in time. Therefore, let us go through the questions. As I can see, the maximum grade you earned is 3 out of 5 for some of you. So what do you think about the questions about the case? Is it very difficult? How do you think? Difficult to understand? Quite difficult. Why is it difficult? So if you can say it in voice, you're welcome. What is not being understood in that case?
Okay, for example, I may try, if you don't mind.
Yeah, sure.
I consider this is an operational risk. So in my opinion, the concept, VAR, etc., they were stated by the bank, in fact. So it's for the last questions, what concept can help bank to prevent this risk, etc. I kind of have difficulties because as I understand, the bank established this let's say metrics, parameters, etc. So it's a problem of supervision. So I have difficulties with last questions.
So
because
as
I consider it. Sorry. Yes, please.
No, so as I understand from your answer that there were no very strict answers, for example, definitely showing the description of the situation. So there are several options, for example, for the same question. So am I right?
Yes, basically, I have difficulties with choosing the right concept that can help bank in this situation, since it's operational risk, not the market risk, in my opinion. So bank established these parameters like where, etc. I believe they calculated this, but failed to supervise this trader who managed to overcome this, let's say, supervision and make the position.
Yeah, you're quite right. First of all, that this is an operational risk mostly, actually, not market risk, because due to the market risk limitations, they were not actually strictly overheld, but this was the lack of control. Nevertheless, thank you for your opinion. Let's go through the questions and answers, and I will tell you about every one. I will tell you about every question in this. The first one was, which risk management principles was mostly severely violated in the Société Générale scandal? There were 4 questions, and the right question, according to this questionnaire, but I understand completely that the situation is not a model, a theoretical model, it's a practical case. Therefore, there are too many issues, for example, might be too many issues, for example, which have not been observed within the case, within the questions. Therefore, it is not evaluated actually. But the right answer here for the first question is separation of duties. Separation of duties. That was, according to this test, the principle most severely violated in Société Générale. And why? For example, the case here highlights, because why not risk limitation? The case highlights actually a significant failure in separating risk-taking functions from risk management and control functions, which allowed Kerviel to take unauthorized positions far exceeding its limits. Actually, this is the first, once we have only one right question. So the separation of duties was the primary cause of the failure, actually. And then, yeah, you are right. Then risk limitation, risk awareness, maybe, and so on. These factors were just derived from the primary one. So that is the logic of the question. So if, for example, on the other hand, if he were not allowed, for example, to exceed the limits, and he somehow exceeded that, then this might be the problem of the risk limitation, because, for example, limits do not work. For example, trading system allowed, for example, to exceed the limits. Nobody observed these limits, and so on. Yeah, separation of duties was the main problem in case of Singapore trader of Barring Nielsen, as far as I remember, but Kerviel surprised. Nelson, I would think so. Okay. So, but anyway, your opinion is very very valuable here, because this case is just the course to start discussion on this situation. But technically, from the standpoint of view of the technical aspect issue of the limitations were not properly observed and monitored, and that is why there was a possibility to exceed these limits. So the second question is, in the context of the 3 lines of defense model, which line failed most prominently in Société Générale case? So as well, 4 answers, and the right answer is second line of defense, risk management and compliance. First of all, so the first line, which is a responsibility of the business unit, it was, I would say, it was not the critical one that has been overcome here in the case, because it was an intention to exceed the limit from the CarVal side. And so the fault was risk management and compliance. So they they possibly did not monitor the risk limits and their utilization properly. So the next question is, which type of risk was most directly implicated in the Société Générale trading scandal? Yeah, and here is an answer: operational risk, as you said before. Why? Because this scandal primarily resulted from failures in internal processes relating to operational risks, for sure, in relation to people and systems. So, people, the intention of Jérôme Kerviel, and systems in terms of the failure in monitoring the exceedance of the limits here. So then the next question is, which risk management approach would have been most effective in preventing or early detection of CarVal's unauthorized trading activities? And here the right answer was stress testing. So therefore, what is the problem? Stress testing here evaluates the potential impact of exceptional but plausible adverse events, and it could be really revealed to the vulnerability of unauthorized trading activities of this magnitude. So the problem here, as from the standpoint of view of the overall bank, actually not in one trader, because I think that, and I remember that there were many cases actually, as to my experience in the banking, where traders exceeded their limits, for example. But the overall general problem was that this system of the bank allowed these losses to grow up, actually, up to the very critical level. Yeah. And that was the problem. So, for example, if CarVal exceeded the limit and lost, from, say, 1,000 euros or 100,000 euros, they might be not so critical to the bank and did not raise up so many problems. Therefore, it's a very general thing, a very general situation. But in that case, sure, the bank was not ready to such huge loss, for example, and even was near to lose all of the capital. What is the next question? In terms of risk measurement approach, which concept was most critically overlooked in the Société Générale case? So I would say that this case demonstrates actually a failure to account for, I would say, unexpected losses, which are really defined in the lecture as potential losses beyond expectations. So these losses have not been expected for sure. And CarVal's unauthorized trades and led to losses far exceeding normal expectations, and highlighting the importance of considering unexpected losses and risk management. Therefore, I think that this is all about unexpected loss. Yeah. And on the other hand, actually, the separation of duties is a part of the operational risk, actually. if we say the compliance is a part of the operational risk, if compliance in some banks, compliance, as I said you before, is not being considered as a part of the operational risk, therefore, this failure actually may be considered as a part of compliance, not a part of the operational risk. But nevertheless, it is mostly close to the operational risk and to not the market risk at all. So, but exceeding of the limits, for example, say exceeding of the limits is not the market risk as well, as you understand. Exceeding the limits is part of the say internal control failure, or for example, internal processes failure, or for example, duties failure, responsibilities, and so on. It is a part of the operational risk as well. Therefore, we can discuss on the proper factor or primary factor of the failure, and I agree with you that that might be a question because the case is really complex, but it is mostly the part of the operational risk for sure. Okay, thank you for your participation, and we can go on with the market risk then. Just a second, I will get ready. By the way, do you see the presentation? Do you hear me? Yeah, sure. Thank you very much. Just in a second, we'll go on. Yeah, that's it. I'm ready. Okay. Now we are shifting our attention to look at the broader picture of market risk management. And here the slide outlines the three key pillars like portfolios, processes, and limits. Portfolios here are very important in terms of the risk management, of the market risk management. This is your actual market exposure, actually. The positions you hold across various asset classes and instruments, what I mean. And therefore, understanding your portfolio and the composition of your portfolio is really a foundation of the risk management here. Processes, for example, are how you manage risk on a day-to-day basis. And this really includes everything from how you measure risk to how you report it, for example, how you hedge and how you respond to limit breaches as well. Limits, what are limits here? Limits are your guardrails, and they define actually how much risk you are willing to take in various dimensions. Without clear, well-defined limits, for example, risk management is just a theoretical exercise. And as you can see from the previous case. And these limits, all of the limits within the market risk and credit risk and operational risk management are usually interconnected to each other. So your processes need to be tailored, therefore, to your portfolios, your limits, and they all of them all together, they need to reflect your risk appetite and portfolio composition and portfolio strategy and so on. So let's dive deeper into the world of risk limits then. First of all, this is where we set the boundaries for our risk-taking activities. For example, at my previous institution I worked for, it was Sberbank. So as I remember, we had over 1,300 limits overall across more than 100 instruments and risk factors. You can imagine. This might seem excessive, but it really gives us a comprehensive view of our risk profile. Usually we have several types of limits, like, for example, value at risk limit. So this kept our potential losses in normal market conditions. It's a statistical measure, typically showing the worst expected loss over a specified time horizon, for example, at a given confidence level. We will get back to it later on. And then stress test limits. So these kind of limits actually usually address the shortcomings of value at risk by looking at potential losses in crisis scenarios. And I've seen cases, for example, where portfolios looked fine under value at risk, but blew through stress limits, revealing hidden vulnerabilities. Because one of the shortcomings of the value at risk, as we will see further, it is that it's not very good at the stress market conditions. So then loss limits. These cap our actual realized losses usually, and this is usually our last line of defense. And finally, sensitivity limits, which cap usually our exposure to specific risk factors, like, for example, as I was said before, like interest rates or forex rates and so on. So the next slide is market risk management limits. So let's talk about the processes that bring our risk management to life and to real life examples. If you are a risk manager, so it's your day-to-day activity that ensure that everything is operating within your risk management framework properly. Sorry. Therefore, we have three main stages of limit control, as you can see here on the slide. First one is preliminary control. So this is our first line of defense. It's about preventing limit breaches before they happen. And in practice, really, this often involves pre-trade checks, for example, real-time limit monitoring, and so on. Then comes intraday control, which involves actually monitoring limits throughout the trading day and providing end-of-day risk summaries, for example. In practice, it is crucial to identify any developing risk concentrations. It's very important from the standpoint of view of the proper risk management. Then comes follow-up control, which is based usually on official data and involves a more detailed analysis of the positions and risk exposures. So if we talk about the and go through the typical process, for example, a trader in the dealing division wants to make a trade. So they first do the self-check against their limits. Then their independent risk management team does their own check as well, and that was one of the failure of the case. They did not do that actually. That is a failure of the risk management, therefore. And only if both checks pass, the deal go through then. What this multi-layered approach gives, it is very crucial and important. For example, I can remember a few cases where a single point of control failed, for example, leading to significant limit breaches. And having multiple checkpoints adds robustness, to the risk management system. And this, it is very important to note that these processes aren't just about saying no to trades. Yeah, there is not a trade-off. They are about actually ensuring we take intelligent, calculated risks that align with our overall strategy well. And the final, by the way, the final goal of the risk management process isn't just to eliminate risk, because it's impossible in our business, for example, in the banking business. If you do not take risk, you do not take money. Yeah, you do not have profit. And here the goal is to ensure we're taking the right risks, not the wrong way risks. Yeah, as we said before, and in the right amount and in the right time. That is important. There is another process within market risk management, which is very important, which is called independent price verification, or IPV process. What is this about? It is really critical, but often overlooked area of risk management. And this is, I would say, absolutely crucial for ensuring the integrity of our risk measures and financial reporting as well. So what is IPV? Briefly, IPV is about making sure the prices we're using to value our positions are accurate and unbiased. And it's a regulatory requirement nowadays, but more importantly, it's essential for sound risk management, because you can imagine, how could we evaluate and manage risks, market risks properly if the raw data is improper, for example, or biased, something like that. That is impossible. And that is why this process usually involves several key steps. First of all, we have to review our valuation models to ensure they are theoretically sound and implemented correctly. Sorry. And then we have to check the market factors that go into these models. For example, things like interest rates, volatilities, and correlations. And then we assess the quality of our market data. In a liquid market, for example, these can be particularly challenging. Then we usually make adjustments for things like model risk and credit risk by means of CVA, credit value adjustment, but we will get back to it further. And the final result of the IPV process actually can have significant impacts. For example, it may affect the reporting of financial results and the risk assessment, for example. As we understand, getting this wrong can lead to mispriced risk and potential large unexpected losses. And the next process, actually, which is rather important for the risk management, is marketability check statistics. So it is really a crucial aspect of market risk management that is often the attention it deserves, doesn't get the attention it deserves. So the primary goal here may be to verify that each transaction conforms to market conditions. Yeah. Therefore, here we can look at for two main things. First one is price, and the question is the transaction price in line with current market prices? The second issue is timing. And the question is here, was the transaction executed at a time that makes sense given market factors? And overall, this process serves two crucial purposes. First of all, it helps prevent fraud. For example, non-market transactions could be a sign of manipulation or unauthorized trading. And the second thing, it ensures accurate risk management. For example, if our trades aren't in market prices, our risk metrics will be off, actually. And there is a question as a result of the previous topic. So you can answer this question or choose one of the proper answers and write it down in the chat, please. It is not evaluated, just to make me aware whether you understand it or not. So which of the following events is a realization of market risk? Therefore, please write down the proper number of the correct answer. Let's take, say, 3 minutes for that exercise. Okay, thank you very much for your answers. Yeah, the proper answer is third. actually. I don't think that this question is very difficult, actually. Therefore, I would not ask you to explain your selection. But if you want, please welcome. You're welcome. Okay, nobody wants. Yeah, because first of all, yeah, the answers uh, are incorrect for sure. The first one, for example, default of a bond issue is a pure credit risk. The second one, incorrect input of transaction parameters, it's an operational risk. And the fourth is regulator imposes fine due to errors. It might be compliance risk actually, or the part of the operational risk. Yeah, and the third one is a market risk. You're quite right. Thank you. So let's go on. Let us go through the value at risk concepts and calculations. As you may know, value at risk is really a fundamental concept in risk management, and it helps financial institutions actually quantify their potential losses. What is value at risk? It's really in general, it's all about understanding the worst case scenario in normal market conditions. Yeah, it's not about at all about extreme events or financial crisis, but rather the everyday risks we face in the markets, for example. And as we go through this, I want you to think about how you might apply value at risk, for example, in real world situations. For example, imagine you are a portfolio manager. How would you use value at risk to make decisions about your risk exposure? You can write it down in the chat, by the way. And during this lecture, so we'll cover the basic concepts, different calculation methods, and some practical applications of the value at risk concept. And I hope that by the end of the lecture, you should have a solid grasp of how value at risk works in general and why it is important in modern finance. And finally, we will come up to the practical work on the value at risk calculation. But I'm not sure that we are in time today with the practical work, but maybe at the beginning of the next lecture. So, okay. First of all, introduction to the value at risk. First of all, value at risk quantifies the maximum potential loss of a portfolio over a specific time horizon and with a given confidence level under normal market conditions. As I said before, if we break down that value at risk and try to understand what it really means, so it might be essential answering the question, for example, how bad could things get under normal circumstances? Yeah, that is about value at risk. And if you notice this graph, for example, it shows a distribution, the graph on the right on the slide, it shows a distribution of potential profits and losses. And here, value at risk is that point on the left tail of the graph, where we say we're X% confident that our losses won't exceed this amount. So X% confidence that our losses would not exceed this amount showed up with a dotted line, red dotted line. So now, when we say normal market conditions, we are excluding major crises or, for example, systemic events. This is crucial, really, because value at risk isn't designed to capture those extreme scenarios. And that is what stress testing should do. In practice, in my practice and general practice, banks often use one-day value at risk with a 95% confidence level. Why? Because it gives us a daily snapshot of risk that we can act on quickly. For example, it is very useful for the trading desk on a day-by-day activities. If they know, for example, they're 1 day 95% value at risk, which helps them to set daily limits and make real-time decisions. So the next one is market risk model requirements. It's not just about crunching numbers, actually. It's about truly understanding and capturing the complexities of the market. Then, first off, your model needs to explain historical price variations to a high degree. And if it can't make sense of the past, how can it predict the future, for example? There is one of the key questions within risk management. So therefore, the majority of the models with their risk management, they are past dependent. You should take it into account. But where it gets interesting, actually, you need to capture a name-related basis risk here. And this is about the understanding how individual securities might behave differently from their broader market or sector, for example. And here, event risk is really crucial too. Let us think, for example, about the major announcements, policy changes, or event defaults, and your model needs, in that terms, needs to account for these potential shocks. For example, if we are back in 2008 financial crisis, which is very well known, there many models fail to capture the correlation, for example, between different securities during the financial crisis. And that's why point 2 here on the slide is so important. Your model needs to reflect changes in portfolio diversification or increasing concentrations as well. And the problem model has to do that in a very good manner. And your model should actually perform well in bad times. And it needs to be robust in adverse environments, for example, and signal rising risk when things start to look dicey, I would say. So what are the major approaches to calculate environment? First of all, there are 3 of them, actually. First of them is parametric, then historical, and then Monte Carlo. So step by step. And each step has, or each approach has its strengths and weaknesses, and understanding when to use each is crucial. First of all, let's consider the parametric model, because this is like the neat freak of the VAR world, actually. It assumes returns follow a nice, tidy distribution, usually normal distribution or Gaussian distribution. In other words, it's quick and it's easy. So, and these are the major benefits of this parametric model. But we should be careful with that, because in the real world, it's usually not so orderly, actually. Then goes the historical model. This is like looking in the rearview mirror. You know, we're saying, for example, what happened in the past is likely to happen again. And that is the main assumption of the historical valuation, value at risk. It's intuitive and it doesn't make assumptions about distributions, for example, but it can miss new risks. That is a shortcoming of the model. And lastly, we have Monte Carlo simulation. And this is our crystal ball, I would say. Why? Because we are creating thousands of possible future scenarios. Those are based on our assumptions. It's flexible, it's powerful, but it can be computational intensive. For example, during one of the financial crises, in the past, many parametric value at risk models failed spectacularly because they assumed normal distribution. And historical models didn't fare much better because the past hadn't seen anything like the present. But only Monte Carlo models, if properly calibrated, had a chance of capturing these extreme events. So this is the main benefit of the Monte Carlo simulation. And while since many banks nowadays use historical simulation of value at risk as a trade-off between these shortcomings and benefits of the models. But I know, for example, that such big, large banks as Sberbank or VTB, they preferably use Monte Carlo simulation for the value at risk calculation of their portfolios on a daily basis, and the simulation takes a night, for example, of computational efforts. That is why Monte Carlo actually is not a single approach, is always the best, but smart risk managers usually use a combination and understand the limitations of each. For example, in practice, you might use parametric VAR for quickly daily calculations and historical value at risk for regulatory reporting. And for example, Monte Carlo for complex portfolios with lots of options. And the bottom line is this: understanding these approaches isn't just about passing exams. It's about knowing which tool to use in which situation, and it depends. That is about these three approaches. What are potential enhancements to market risk model? Now let's talk about souping up our market risk models. And these enhancements, I would say, they are like adding a turbocharger to a car. They give you a more powerful power to navigate your market conditions. First of all, for this purpose, we have stressed VAR. This is like asking, for example, what would your value at risk look like if we were in the middle of a financial crisis? So, and it is a way of pressure testing of our risk estimates. In other words, then there is the incremental risk charge, or IRC, and this is all about capturing those sneaky risks, for example, that traditional value at risk might miss. Yeah. For example, those things like credit migration, like default risks, and so on. During the crisis, actually, many banks were, as I remember, were blindsided by risks that their value at risk models didn't capture. Yeah, and that is one of the problems of the so many bankruptcies and so large bankruptcies sound at once. And these enhancements are directly response to those failures, I would say. And in other words, these enhancements aren't just about calculating bigger numbers. They are about fundamentally changing how we think about risk. We are moving from a narrow day-to-day view to a more comprehensive and forward-looking approach. This is the meaning of these things. So let's go on with the economic capital for market risk in a bank then. We can start with the formula first of all, which is the capital at risk for the market under the market risk, which equals actually capital at risk for forex risk, for interest rate risk, and for price risk minus basis risk. It looks really simple, but in practice, there are a lot packed into each of these components, actually. Let's break down, for example, for the, first of all, for the forex risk. That is your foreign exchange exposure in practice. and interest rate risk, the interest rate risk exposure, and price risk. Usually that's everything else like equity and commodity risk and so on. Here we you should understand that we're not just taking these numbers at face value, but rather we are adding what we call plus factors. These are add-ons for model risk based on a backtesting results, for example. What else? Let us consider incremental risk charge model in a more detailed way. It is actually all about capture and default and migration risk for credit products within trading portfolio. That is why it is a part of the market risk, actually. Now, when we apply this model, we are looking at a 1-year horizon with a 99.9% of confidence level, usually. This is, you should understand that this is a pretty extreme scenario. Here is the key. We are, when applying this method, we are focusing on unsecured, usually credit products in the trading book. Yeah, for example, like corporate bonds or CDS, for example, and so on. And when we apply this, we also assume a constant level of risk. What does it mean? That means either a static portfolio or a balancing as rating change, for example. It's a simplification for sure, but it helps us isolate the credit risk company. The next one, what is the calculation of incremental risk charge? Usually we start with the generating of joint rating scenarios, and this is just about individual issues. So we are looking at how ratings might move across our entire portfolio. It's like playing, a complex game of chess, anticipating multiple moves ahead. Then we usually simulate and evaluate our instruments under these scenarios. And this is for sure is very computationally intensive. It's very similar to the Monte Carlo simulation. Then we go to the scenario-based loss distribution, and then we reevaluate our portfolio according to this distribution. So then goes stress testing. So stress testing, as you know, this is an additional measure to evaluate risk, while it not capture extreme scenarios in the market. That is why we should implement stress testing into the market risk evaluation and assessments. Because value at risk, as you remember, are based on normal market conditions. For example, but as we can see during the financial markets, so they don't always behave normally, and therefore stress tests help us to prepare for those black swan events. In essence, actually, stress testing involves assessing our portfolios under unlikely but possible pessimistic scenarios. For example, there is an approach which is called what if analysis. What if something happens? What if yield curve moves upward, for example, for 1 basis point? I don't know, and so on. And stress tests usually serve multiple purposes. For example, they help us set capital buffers, manage liquidity, manage uniform business planning, and define our risk appetite. We typically, during this implementing this method, we typically run both top-down tests, looking at the entire bank, for example, and bottom-up tests, focusing on specific portfolios or risk types even. And here stress tests, for example, are as much as part of the science. And the challenge here may be in creating scenarios that are severe enough to be meaningful, but plausible in the same time enough to be taken seriously. So as I told you, there are two approaches, top-down and bottom-up. And what is a stress testing in the bank? Actually, we have several approaches to the stress testing. The main approaches are sensitivity-based and scenario-based approaches. For example, sensitivity is like turning one dial at a time. For example, the question is, what happens if interest rates spike? Or scenario-based is more holistic approach. For example, here the question may be, what if we have another 2008 style financial crisis? What happens to the bank's assets, to the bank portfolio's value, and so on? And for example, if we are not just talking about 1 in 100 years events, so we are looking at scenarios that might happen once in 13 million years, for example. Why? Because extreme events do happen and we need to be prepared. So that is why there is a wide range, or there should be a wide range of stress scenarios within banking. Here you can see the examples of the stress testing scenarios. For example, crisis of 2008 or 2014. Then, for example, shift of the interest rate curve, stock indices fall by 40% at Donna, and exchange rate change by 20% and so on. I will omit this slide. So what is an algorithm of the stress testing scenario development then? When we start with the scenario development, we have to bring together experts from across the bank, from credit risk, market risk, front office, treasury, economists, macroeconomists, for example. It's like assembling the averages of the risk management overall. Next, we do the first risk assessment, for example. This is our really check. If this, for example, the question is this scenario actually going to tell us something useful? Then we move to scenario approval. For example, where senior management weighs in, and they may ask you, for example, does this scenario align with our risk appetite? Is it plausible enough? Is it severe enough to be meaningful? Usually, actually, the scenario development process isn't just about the scenarios themselves. It's obvious, but it's about building institutional knowledge and risk awareness overall. The next thing that this process should be iterative. So you run a scenario, learn from it, refine it, and run it again. And over time, a scenario should become more sophisticated and more tailored to your specific risks. That is why it is iterative. Here on the slide, you can see an example of the calculation of stressed VaR, for example. It is where we can take our VaR model, for example, and crank it up to 11. Here, the key difference between standard value at risk and stressed value at risk, which is a part of the stress testing, is the data we use, actually. I will explain that. For stressed VaR, value at risk, we're usually looking back at periods of significant financial stress. Often, actually, this means using data from one of the financial crises in the past. And if you look at the formula here on the slide, for example, we are taking the maximum of yesterday's stressed VaR and the average stressed VaR over the last 60 days here, which consequently multiplied by a factor. And here we are adding that to our standard value at risk calculation. That is the meaning of the formula. What else? So it's like an add-on. Yeah, in other words. Then let's look at the effect of inclusion of stressed VaR and IRC incremental risk charge in market risk capital. So just briefly, if we look at this chart on the slide, so we are seeing potential increases in capital requirements of, for example, up to 300% compared to Basel II. This is not a tipper, by the way. We're just talking about tripling capital in some cases, actually. That is too much, excessive value. And here the big drivers are stressed VaR and the incremental risk charge of the estimation. Here you can see that the stressed VaR is essentially doubling our value at risk-based capital requirements. And so you can imagine what is the value of the underestimation of the simple VaR approach. And IRC is adding a whole new layer on top of that. Okay, and when you calculate the increased capital requirements, it just not just about having a bigger cushion, for example. They're changing the economics of trading activities, actually. And what is profitable under Basel II might not be profitable, for example, under Basel III due to these changes. So we have come up to another question to the end of the lecture. So therefore, please read the question and answer very briefly whether it increases or whether it decreases. All other things being equal, the value at risk value when the term increases, the term of the value at risk increases, or the term of holding position increases, for example, from 1 to 10 days, whether the value estimation increases or decreases. Please write it down in the chat. Let's take 1 minute for that. Okay, I do not see answers. Are there any problems? Do you hear me? Yeah, thank you. Yeah, it increases for sure. Yeah, it's not a very difficult question. Why? Because it's longer term, great uncertainty. Okay, today we are going to proceed on the market risk assessment from the previous lecture. And this class will be devoted partially to the market risk estimation, and we will start credit risk management as well. So the first topic we will go through will be parametric value at risk and historical simulation value at risk. So we actually have already studied the concept of value at risk. And you can remember that value at risk in general means the estimation of the worst loss scenario with the confidence level and the given horizon. For example, 1 day or 10 days. But actually, we will dive into the fundamental approaches for calculating value at risk, and our practical work further on will be devoted to this calculation as well. In general, there are 2 or 3 general methods for the value at risk calculation. And 2 the most widely used are parametric method, or variance, covariance, never mind, and historical simulation, as you can see here. In general, these 2 methods, they represent different philosophies in risk management, and each of them has its own strengths and weaknesses. For example, the parametric approach is based on statistical assumptions about the distribution of returns, while, for example, historical simulation relies on actual past data. And it is really crucial to understand both methods because they can yield different results, especially in turbulent market conditions. There is another method which is called Monte Carlo simulation. We will go through it after this topic. So let's consider a real-world example. For example, during the financial crisis 2008, many banks heavily relied actually on parametric value at risk. And this led to underestimation of risk as market behaviors deviated significantly from normal distributions. This is the weakness of parametric approach. Any questions before we go on? So no. Let's begin by clearly defining value at risk, or VAR. First of all, it's a single summary statistic that tells us the worst expected loss over a target horizon within a given confidence level, as I said before. For example, if we say a portfolio has a one-day value at risk of, say, $1 million at a 99% confidence level, then we are saying that there is only a 1% chance that the portfolio will lose more than $1 million over the next trading day. And here the time horizon is crucial as well. Typically, we use a 1-day or 10-day horizon for assessment of the market risk. But the Basel Committee requires a 10-day value at risk for regulatory capital calculations. And the confidence level is equally important. For example, while 99% is common, but some institutions, for example, use or may use 95% for internal reporting or 99.9% for economic capital calculations. For example, a real-world example. So imagine that you're a chief risk officer of the major bank, and you need to report to the board of directors that your trading desk has a 10-day value at risk of $50 million at 99% confidence level. And this means in general that you are 99% certain that your trading losses won't exceed 50 million over the next 2 weeks, because 10 working days means 2 weeks, 2 calendar weeks. And it's important to note that value at risk doesn't tell you how much, for example, you might lose in that 1% worst case scenario. This is a key limitation that we will discuss later. And for example, in my experience, senior management and regulators find value at risk appealing because it boils down complex market risk into a single, easy to understand number. And however, we can say that this simplicity, for example, can also be dangerous if not properly understood. While we go through the lecture, I asked you to think about it. How would you, for example, as a risk manager, explain to a board member why we can't simply use value at risk as our only risk measure? So what are the general shortcomings of the measure? Okay, let's consider the barometric approach to calculating value at risk in a more detailed way. First of all, the cornerstone of this method is the assumption that returns follow a normal distribution. And this means actually that we can fully describe the distribution with just 2 parameters. First of them is mean, and second of them is standard deviation. But in practice, we estimate volatilities of individual risk factors and correlations between them. And these become the building blocks of our value at risk calculation, indeed. For instance, we're calculating value at risk for a portfolio of stocks, and we would estimate the volatility of each stock returns and the correlations between different stocks as well. And this highlights really a key limitation of the method. The limitation is that the barometric approach assumes that past patterns of volatility and correlation will hold in the future. And in reality, this can change rapidly, actually, especially during market stress. But despite the limitations, the parametric approach remains really widely used due to its computational efficiency. For example, for large portfolios with thousands of positions, it can really provide a quick and reasonable estimate of risk under normal conditions, for example. But nevertheless, despite the limitations, this approach, the parametric approach, remains widely used. Why? Because of its computational efficiency. And for example, it can be used, as I said before, for large portfolios with thousands of positions. And but there is a critic, actually, to this method. For example, as a risk manager, using it, you should always be aware of your model's assumptions. For example, when market conditions violate these assumptions, then your risk estimates may become unreliable even. So it's very dangerous to use it without proper consideration. Okay, let us consider particular pros and cons of the method. First, let us consider advantages of the method. First of all, the parametric method is remarkably simple and fast to compute, and this is a significant benefit in real-world risk management scenarios. For example, to speed of calculation, here, the speed of calculation using this method here means that we can quickly update our risk estimates as market conditions change. For example, this is vital actually in active trading desks and where, for example, positions change rapidly throughout the day. But there is also a significant caveat. For example, the assumption of normally distributed returns is really shortcoming. Yeah. First of all, in reality, we should say that financial returns often exhibit fat tails, so-called fat tails, which means extreme events occur more frequently than a normal distribution would predict. Yeah, for example, during different financial crises, many banks using parametric value at risk, as I said, severely underestimated their risk. And for example, the market experienced several Six Sigma events within just a very short period of time, something that should occur once every 1,000 years under normal distribution, for example, which is a base of the parametric VAR. And this understanding actually of tail risk can lead to insufficient capital buffers and potential solvency issues during market stress. But here I would notice that some advantages of the parametric methods or some advances of the parametric methods attempt to address this by using alternative distributions, like, for example, students or t-distribution, which may have, for example, a fatter tail. Yeah. So what about historical simulation, value at risk? Let's turn our attention to this very widely used method of calculation. Here, the core idea is beautifully simple, actually. Why? Because here we can use actual historical returns that could happen to the project, for example, or to our portfolio in the future. And it's like replaying history to see how our current portfolio would have performed, for example, in the past, if the past occurs now. Yeah, and how this is how it works in the practice. Let's say we are calculating a 1 year one day value at risk, for example, using 2 years of historical data. We would apply actually each of these past 500 or so daily market moves to our current portfolio, generating 500 scenarios of potential one-day returns. And a key advantage here, a key advantage of this method is that we don't assume any particular distribution of returns like using the previous method, parametric one. And in these terms, if the market has fat tails, for example, that will be reflected in our historical data and thus in our value at risk results or estimate as well. This might be actually valuable for portfolios, for example, with nonlinear instruments like options, and for the historical simulation naturally may capture these linearities without requiring complex modeling. And we have to understand also that this method assumes that the future will look like the past. So it's a historical simulation. Because of that, if we enter a new market regime, for example, during the crisis or due to new regulations and so on, then historical simulation might not capture the new risks rather adequately. Yeah, we have to understand this very well. Okay, let's consider in particular strengths and limitations of the historical value at risk simulation. First of all, the major advantage is its ability to capture fat tails of the distribution, as you remember, and distribution of returns for sure. Unlike the parametric approach, we don't assume normality here. So here, extreme events in the historical data are fully reflected in our value at risk estimate. Another key strength here is that it's non-parametric. So we don't need to estimate volatilities or correlations, which, for example, can be challenging for complex portfolios or for illiquid assets. And furthermore, this non-parametric nature makes historical simulation particularly useful for portfolios with options or other non-linear instruments. Because, as I said, this method naturally captures the non-linear payoffs without requiring complex modeling. However, one of the main shortcomings of the method is its reliance on historical data, which is, on the one hand, is both its strength, and on the other hand, is its weakness. For example, the value at risk by means of historical simulation estimates only a risk on a rather sufficient level or confident level, just for in case that history occurs in presence. So the history repeats. There were actually many lessons from different financial crises about this implementation of the method. For example, many banks' historical simulation value at risk models failed actually to capture these extreme market moves because the historical data didn't include a comparable period of stress. Another thing I should tell you that if the chosen historical period is too short, for example, then we might miss important tail events. So we might underestimate the fat tail of the distribution, of the historical distribution. For example, if it's too long, then we might include outdated data that is no longer relevant to current market conditions. And another limitation of the historical simulation here assumes that all past scenarios are equally likely to occur in the future. And this for sure might not always be realistic, especially if market structures have changed. So let's discuss another crucial aspect of risk management. The importance, in particular, the importance of using multiple approaches to get a comprehensive view of risk. For example, both parametric value at risk and historical simulation really have their strengths and weaknesses, as we discussed. And the key is to leverage the strengths of each method while, for example, mitigating their individual shortcomings. Here, stress testing involves creating hypothetical severe market scenarios, for example, and seeing how our portfolios would perform. And these scenarios must be based on the historical events or purely hypothetical what-if situations. So, and that is why stress testing is inevitable when we use value at risk. We use it usually as an add-on to our value at risk estimation. And therefore, using multiple approaches really gives us a more robust view of risk. For example, if parametric and historical value at risk give similar results, it increases our confidence. And if they diverge significantly, for example, it may prompt us to investigate why. By means, for example, of the stress testing methods. And therefore, that is why stress testing really complements value at risk by helping us understand actually potential losses and scenarios that may not be captured by our historical data or our statistical assumptions. In practice, this multifaceted approach has become industry best practice. And for example, especially during financial crises, those actually highlighted the danger of over-relying on a single risk measure, which is obvious. Sorry. Okay, now let's critically examine the limitations of value at risk, and let us discuss in particular why it is crucial, for example, to use it alongside with other measures, as we said before. As we understand now, value at risk is a very powerful tool, but it's not a crystal ball, actually. And as we discussed, its biggest weakness is maybe exposed during market crisis when historical patterns of volatility and correlation can break down dramatically. For example, in normal times, corporate bonds and stocks often move in opposite directions. Yeah, as you may know from the financial market course. But during the crisis, they plummeted together, which actually may cause much larger portfolio losses when we try to predict the value at risk estimation. And here, value at risk usually doesn't tell us how bad things can get beyond, for example, the specified confidence level. For example, a 99% value at risk tells us nothing about the potential severity of that 1% tail event. And another limitation of value at risk actually, which may have the potential to create a false sense of security. So, for example, there were many traders that were saying in the past, but our value at risk is within limits. So what is the problem? So this can actually, in practice, lead to complacency about tail risks. And so the solution, as I said, is to use value at risk just as part of a suite of risk measures, actually. And here we can discuss, for example, the following complementary approaches to the general value at risk estimation. For example, there is a measure like expected shortfall or conditional value at risk, which actually may tell us the average loss in the tail beyond value at risk, beyond, for example, parametric or historical value at risk. So it investigates just the tail of the distribution. Then another approach is stress testing. And as we discussed earlier, this may help us understand performance in extreme scenarios. So another approach is scenario analysis, when we model specific plausible market events and their impact. Then we can analyze risk factor sensitivities and risk factors and their sensitivities, where we can look at how changes in individual risk factors affect the portfolio, for example. So when you are designing a risk report for senior management, you have to always think what key risk measures would you include alongside value at risk and why. So there might be a reason. So we have come into the first question. Here is it. So which of the following is not mentioned as an advantage of the historical simulation approach to value at risk calculation? Please select one of the answers and write it down in the chat. So I will give you, say, 3 minutes to do that. Okay, great. I can see your answers, and this answer is correct. Yeah, that's right. Why? So let us try to explain this. First of all, we have not discussed in particular, so that historical simulation value at risk performs, for example, better in stable market conditions. But in fact, it emphasizes that historical simulation accuracy depends heavily on the chosen historical period of time and can be problematic if market conditions change. So the other options, 1, 2, and 4, are all mentioned as advantages of the historical simulation approach, and so they are not shortcomings. So, and they were not, they were mentioned actually in the lecture. So let's go on. If you do not have any questions, and you can write down your questions in the chat for sure. Let's go on. So the next more advanced approach to value at risk calculation is Monte Carlo, which is actually a sophisticated simulation technique we can use to estimate value at risk to, for example, complex financial portfolios. So at its core, actually, this method involves generating thousands or even millions of potential future scenarios for market and for market prices and, for example, rates and currency rates and so on. Actually, this gives us a comprehensive distribution of possible portfolio values. And here, the beauty of Monte Carlo lies in its ability to handle complex and non-linear portfolios that, for example, other methods struggle with. And it may be particularly useful for portfolios containing, for example, options, structured products, or other derivatives even. For example, how it can be applied in the real world. So imagine that we are managing a global macro hedge fund. So our portfolio then might include long and short equity positions, currency forwards, interest rate swaps, commodity options, for example. And here, by the interaction between these instruments may be complex and non-linear. And that is why Monte Carlo value at risk estimation really allows us to capture these intricacies in our risk management. This process actually works by simulating the random processes that govern market prices. And for instance, we might model stock prices using geometric Brownian motion, for example, interest rates and mean reverting process, and exchange rates for jump diffusion models, for example. So there are so many applications and means of using this Monte Carlo simulation. And here, each simulation or each scenario may generate a possible value for our portfolio at the target horizon, say 10 days from now. And we can run these thousands of these simulations. And by this, we can build up a distribution that converges towards the true, albeit unknown distribution of our portfolio's value. During financial crises, as we appealed to it before, actually many risk models failed because they underestimated the probability of extreme market moves. And for example, during these times, Monte Carlo simulations properly calibrated can really help us capture this tail risk. So, and the power of Monte Carlo method, I would say, really shines when dealing, for example, with complex multi-asset portfolios, or when we need, for example, to model intricate market dynamics, or it can capture risks that simpler methods might miss, for example. And it can provide a comprehensive view on potential losses. Therefore, okay, let us consider Monte Carlo simulation steps. The first step is to specify all the relevant risk factors. This is a very crucial first step, actually, and during this step, we need to identify all market factors that, for example, could significantly impact our portfolio value. And usually, for each factor, we specify a stochastic process, which means the mathematical model describing how it evolves over time. And then we can estimate the parameters for these processes. This may, for example, include volatilities, correlations, say mean reversion factors for interest rates, and so on. For example, let's say we are managing a global equity portfolio. Then actually we might model stock prices using geometric Brownian motion, for example, with parameters estimated from historical data. For interest rates, for example, we might use a mean reverting process like, say, Vasicek model, which is widely used for the interest rate simulation for the purpose of the value at risk assessment. And here it's critical to capture all of the correlations between all of the risk factors. Because in stressed market conditions, actually correlations often increase, which may lead to larger portfolio losses comparing to the uncorrelated moves of the rates or equity prices and so on. So the next step is to construct price paths. This is really where the Monte Carlo simulation comes in. So because we use random number generations to simulate possible future paths for each risk factor separately. And here, now, for example, for a simple portfolio, we might generate the 10-day distribution in one step. And for complex portfolios, otherwise, we often simulate day-by-day changes to capture path-dependent effects. Now, when we deal with multiple correlated risk factors here, we usually need to simulate from multivariate distributions. Because why? Because this ensures that the simulated scenarios maintain the correct correlation structure. By the way, a common technique that may be used here is so-called Cholesky decomposition, yeah? Which is really generally used to generate correlated random numbers from uncorrelated standard normal variables. For example, if we are simulating both equity and bond returns, we actually need to account for the typical negative correlation between these asset classes. And the final step is value the portfolio for each path or for each scenario, according to each scenario. For example, for each simulated scenario, we now have to set our values for all our risk factors. And we use actually these risk factors as inputs to our pricing models to calculate the portfolio value under the appropriate scenario, specific scenario. This step actually may be repeated thousands of times, for example, often 10,000 of times or more, to generate a robust distribution of potential portfolio values at our risk horizon. Therefore, this computational intensity of this step depends on the usually depends on the complexity of our pricing models, for example. But for a portfolio of linear instruments like stocks or bonds, it's relatively straightforward. So, but on the other hand, for say complex derivatives, we might need to use numerical methods or even nested Monte Carlo simulations. So once we have our distribution of portfolio values, calculating value trees becomes really simple. For example, for a 99% value trees, we just need to find the first percentile of this generated distribution of scenarios. Therefore, this will be our value at risk according to the Monte Carlo simulation. So now let us consider pros and cons of Monte Carlo simulation. Actually, this approach is incredibly versatile, but it's not without its drawbacks, as every method we considered before. On the plus side, Monte Carlo can handle any distribution of risk factors you throw at it. For example, whether you are dealing with normal distributions, skewed ones, or even multi-model distributions, Monte Carlo can accommodate them all. Actually, this flexibility is really crucial when we are modeling real-world financial scenarios that often don't follow neat theoretical patterns. So another major advantage of this method is its ability to model complex portfolios. For example, in my experience, we've seen Monte Carlo simulations and applied them for model portfolios with hundreds of different assets, including derivatives and other complex instruments. And in practice, this makes it really invaluable tool for large financial institution managing diverse portfolios, for example. So Monte Carlo, furthermore, allows you to calculate confidence intervals with value at risk assessment. So this is huge, actually, because it gives us a measure of the precision of our value at risk estimate, and the ability of this method to perform sensitivity analysis and stress testing is another key benefit of the method. For example, you can easily shock different variables and see how they impact your portfolio. For example, frankly, I've used this capability to help clients prepare for various market scenarios, from minor fluctuations to major economic crises. So, however, it's not as good as it's seen. So the most significant drawback of the Monte Carlo simulation often is often don't incorporate outliers into the distribution, and otherwise this can lead to underestimation of tail risks, which, as we all know, for example, can be catastrophic in finance, and especially during financial crises. And lastly, these simulations can be incredibly computer intensive, actually. For example, I know risk management departments needing to upgrade their hardware just to run more complex Monte Carlo models. While, for example, computer power is always increasing in these terms. But therefore, it may be actually a significant barrier, especially for smaller firms, companies, or when quick results are needed. So it's not the proper implication of the Monte Carlo simulation. Okay, let us consider another measure, which is based on the Monte Carlo simulation, but is used for the counterparty risk assessment. And it is called credit valuation adjustment. We will go through this method further on during our class devoted to the credit risk management. But just to let you know, to let you aware, to make you aware, so I will discuss this method beforehand, because it's a very bright illustration of the implementation or application of the value at risk simulation. So this is in general, this is one of the most crucial concepts in modern derivatives valuation and their risk management. So in essence, CVA, credit valuation adjustment, or credit value adjustment, it is an adjustment to the fair value of a derivative to account for the possibility that, for example, the counterparty might default. It is really the difference between the risk-free portfolio value and the true portfolio value that considers counterparty credit risk, for example. CVA also serves multiple purposes. For example, it may be used in international financial reporting standards, in terms of reporting, in regulatory reporting, and in economic capital calculations as well, and even in front office pricing and hedging decisions. It can be used, therefore. One key insight from my experience, for example, says that CVA can be a significant source of P&L volatility. Actually, for example, during financial crisis, the 2008 CVA losses were substantial for many banks. As you can see, calculating CVA isn't really trivial. It requires modeling of the both market risk factors and credit risk factors, and you have to model them over the life of the, for example, derivatives portfolio. And also CVA is closely related to concepts we discussed earlier, like runway risk, for example. And in fact, a runway risk can significantly increase CVA. For the risk, from the standpoint of view of the risk managers, CVA can present both challenges and opportunities. It's a complex, on the one hand, it's a complex risk to manage, but also a potential source of revenue through CVA hedging, for example, and optimization, which might be a service to your clients. So you might sell your CVA estimations to your clients like premiums, risk premiums, or risk discounts. We have to remember also that CVA is just one of the several valuation adjustments, which are called actually in terms of the counterparty risk management XVAs. These measures might be or have to be considered by the banks for sure, by the banks operating on the financial markets, especially on the out-of-the-counter market. So another measure, for example, which is opposite to the CVA is called DVA, which means debt valuation adjustment. And there is for example, valuation or metric like FVA, which means funding valuation adjustment. So there are plenty of the measures of the counterparty risk, but all of them preferably are based on the Monte Carlo simulations. So here we have come to another question. So let's get for about 3 minutes for that. So the question is, which of the following is not a key step in the Monte Carlo simulation approach for calculating value at risk? So, and 4 answers, one of which is right. So please select only one question and write it down in the chat, please. Okay, thank you for your answers. So I can see they are rather different. Yeah, but the right answer is 4. You are quite right, those answering 4. Why? Because so the 4th answer is calculating the covariance metrics of all assets in the portfolio. The Monte Carlo simulation approach really for value at risk calculation, as you understand, involves 3 main steps: specifying risk factors, constructing price paths, and valuing the portfolio for each of the definite path of the specific path. And therefore, calculation of the covariance metrics is not a specific step in the Monte Carlo method, but rather, I would say, a component of the variance-covariance approach to value at risk calculation. So thank you for your answers. Let's go on. Okay, then let us consider backtesting value at risk models. So what is backtesting? It's an essential process for evaluating risk models quality and their predictive power, actually. So it is crucial to assess the accuracy and reliability of value at risk models. And in general, backtesting is the process of comparing predicted value at risk with actual portfolio performance. And it's generally essential for validating our risk models and ensuring their predictive power. So we'll walk through this concept requirements and implementation of the backtesting. But first of all, we have to understand how to effectively backtest our value at risk models to maintain regulatory compliance and manage risk effectively. So let's go on. So let's discuss what is a backtesting concept in general. So first of all, effective backtesting in the bank or in the company, non-financial company, it requires a comprehensive framework and independent validation for sure. And the core of backtesting is comparing our value at risk predictions to actual price movements. For this purpose, actually, we may exclude new trades, for example, from our estimation to ensure a fair comparison. And this is really crucial for accurate assessment. Here, the number of outliers, for example, or times when losses exceed value at risk may tell us about our model's quality. And it's not just about counting outliers, but we need to analyze why deviations occur. We have to explain them. And for example, in my experience, this analysis often reveals hidden risks or model weaknesses we hadn't considered before. And here, independence is a key for sure, because backtesting should be done by a separate team from those who developed the model. So there must be so-called Chinese wall between these two departments, the developers of the model and backtesters. This independence help really to prevent biases and it ensures objective evaluation. But to sum up, our main goal here within the backtesting is not just to check a regulatory box. So we are usually trying to genuinely improve our risk management. So it's more applied for the internal use. So how is backtesting organized? For example, in large companies and large organizations, we usually need a centralized approach to backtesting, actually, and this usually ensures consistency, but on the other hand, it allows for local adjustments when necessary. For example, I've seen companies who struggle when different divisions use inconsistent backtesting methods. Centralization here helps very much, but we need also good data flow from all entities to make this approach, this methodology work. And in practice, therefore, this often requires breaking down silos between departments. So the results are usually feed into the company's wide market risk reporting, and therefore this holistic view is crucial, usually for senior management, just to understand the overall risk profile of the company. So let us go through the general or main backtesting methods. So there are generally two of them, clean and dirty backtesting. Here, as you can see, clean backtesting freezes yesterday's portfolio and revalues it with today's data. By means of that, it isolates market movements from portfolio changes, and dirty backtesting in general uses actual P&L, profit and loss, including even effects of new trades. And it is really more realistic, but it can make it harder to identify model weaknesses, for example. And in my experience, using both methods can give us a more complex picture. For example, clean backtesting might show our model may be or might be accurate, but dirty backtesting reveals operational risks of the model. So, but the final choice actually depends on your specific needs and regulatory requirements. We expect usually the value at risk measure to be exceeded sometimes. So that's built into the confidence level actually, because it's not equal to, it is not equal to 100%. And the challenge here maybe is determining when we have too many exceptions that's supposed beforehand. For example, we can use statistical hypothesis testing to make this determination, or we can apply, for example, a Kupik test, which is a very common method here. So, for example, we can use a likelihood ratio to test if our observed exceptions match really the expected rate. And this might sound complex, really, but it's essential for objectivity and for objective evaluation of our models. And actually, in practice, I found that visual representations of these tests might help communicate results to even non-technical stakeholders. So here's, you can see the visual representation of the Kupik test results. And you can see that these charts show the non-rejection regions for 99% and 95% value at risk measures. You should notice here how wide these regions are actually. That's one limitation of the best of the test. With 1 year of data here, we have lower power to reject a bad model. But another issue is the assumption of independent exceptions. And in reality, therefore, exceptions often cluster during periods of market stress, and it was said. And there are a lot of really cases where models, for example, passed this test, but still failed during crisis. You know, this is very common. But nevertheless, we need actually, that is why we need to complement this with other validation techniques. So, and what about P&L calculations versus value at risk? So, to compare P&L, profit and loss of our portfolio during the time, to compare it with value at risk, we really need to ensure where we are comparing apples to apples. Yeah. So, what does it mean? It means that actual P&L includes many factors. Those actually may not relate to market risk. And here we can have two main approaches: cleaning actual P&L or calculating hypothetical P&L. For example, cleaning P&L involves removing effects like fees, provisions, and intraday trading even. And hypothetical P&L actually revalues yesterday's portfolios with today's prices. So I would say that in my experience, for example, hypothetical P&L is often easier to implement consistently. But by cleaning actual P&L, it can provide insights into other sources of risk, on the other hand. But the key here you should understand is to understand what each method tells us about our risk and our model's performance. So the next slide is about validation concept for the market risk models. First of all, as we understand, validation goes beyond just backtesting. It's a really comprehensive process. First of all, we need to validate models after development and after major changes, and even periodically, annually, for example. Therefore, a good validation framework includes qualitative, usually, and quantitative elements. And qualitative validation might assess model assumptions and methodology, while quantitative validation usually includes backtesting and stress testing. We also need usually to validate our market data because garbage in, garbage out, as they say. And I found, honestly, that clear validation policy is really crucial for consistent application of the methodology of the backtesting. So model validation isn't just the job for one team. It really requires inter-team collaborations. For example, risk model developers create and document the models, while market risk controllers usually operate the models and perform daily backtesting. And here, the validation team may design and coordinate validation tests, for example. But these roles may be interchanged, by the way. And instrument model validators in that sense ensure compatibility with market risk models. For example, market data teams, if they are in the risk management department, they may ensure data quality. Risk committee oversees here the whole process, and there might be set up clear communications between these groups, which is really crucial as to my experience. For example, feedback from market risk controllers often leads to model improvements. Yeah, and you should remember either that validation is an ongoing process. It's not just a one-off event or one-time event. So, but we should add that not all aspects of a model need to be validated within the same frequency. For example, daily validation is needed usually for high-frequency inputs, like, for example, market data. But monthly validations, by means of monthly validations, for example, we might check the model's predictive power through backtesting. We may apply also quarterly validation, where we might review, say, assumptions for less liquid markets. And for example, we may apply even annual validations or yearly validations, by means of which we can review, for example, fundamental model assumptions and overall architecture as well. So this tiered approach balances thoroughness and, I would say, efficiency of our modeling. But in practice, actually, I would stress your attention that flexibility is a key, because we might need to adjust this schedule based on market conditions or model performance. And the goal finally is to catch potential issues before they become problems. While, for example, they are not overburdening our teams with constant full-scale validations. So, and here, we have come into the next question. So, please answer, what is the primary purpose of clean backtesting and value-at-risk model validation? So here are 4 questions, and only one of them is correct. Please write your answer into the chat. Let's get 3 minutes for that. Okay, I can see your answers, so that's fine. Yeah, you are quite right. The second answer is quite right. Why? Because clean back testing involves freezing the portfolios from the previous day and assessing it, for example, with the current market data. This method, as it was said before, isolates the effect of market movements from changes in the portfolio composition, which actually allow for a more, I would say, precise evaluation of the value at risk model's accuracy even in predicting market risk. Yeah, that is why the second answer is right. So if you do not have any questions, let's go on. So let's consider the use of derivatives for the purpose of market risk hedging or market risk management. So as we begin our discussion on derivatives, let us start with the fundamental definition. So first of all, a derivative is a financial instrument whose value is derived from the value of other underlying variables. Yeah, first of all. And it's really important to note that these underlying variables aren't just limited to just traded assets, but in fact, derivatives can be based on almost any variable you can think of. This flexibility is what makes derivatives such powerful and versatile financial tool. Actually, to give you a real-world example, for example, whether derivatives are used by energy companies to hedge against unexpected temperature changes that could affect, for example, energy demand. And this underlying variable here isn't a traded asset actually, but rather temperature readings. So, and here, the key insight is that derivatives allow us to create financial instruments tailored to specific risk or a specific opportunity. But even when those risks, for example, aren't or may not be directly tradable in the market. So here are a few examples of derivatives. So now let's look at some common types you'll encounter in the financial world, for example, or you may encounter in the financial world. For example, we have future contracts, forward contracts, swaps, options, credit derivatives, and interest rate derivatives as well. Each of these instruments serves a unique purpose in risk management, actually, and in speculation. For instance, a farmer might use future contracts to lock in the price of their crop before harvest, for example, which may allow him to protect against potential price drops. So, but it might be fascinating to see how these instruments have evolved, actually. For example, did you know that futures contracts have been around since ancient times? Actually, so they existed in ancient times. For example, the first recorded use was in ancient Mesopotamia for agricultural commodities. So as we go through each type, try to think about how they might be applied to your, for example, possible risk management approaches, risk management techniques. So let's start with the forward contracts then. So in essence, a forward contract is an agreement between two parties to buy or to sell an asset at a specified future time for a specified price. So what sets forwards apart from futures is that they actually traded over the counter, which means they are customizable to the specific needs of the parties involved. So, but in my experience, for example, I've seen forward contracts used extensively in currency market. For example, a US-based company expecting a large euro payment in 6 months might enter into a forward contract to lock in the exchange rate, which is obvious. that might protect it against potential currency fluctuations. And the forward market, the forwards are very flexible because of that. They may be particularly useful for business dealing with unique risks of non-standard quantities or time frames even. Let's talk about the forward price. This is actually the forward price is actually a delivery price that would make the contract have zero value if it were negotiated today, for example. But it's really important to understand that the forward price can vary depending on the contract's maturity, for example. And this happens because factors like interest rates, storage costs, and, for example, market expectations can influence the price differently over various time horizons. For instance, in the oil market, the forward price for delivery in 1 month, might be different from the price for delivery in 6 months, due, for example, to storage costs and market expectations about future supply and demand. So by this, let's make a break for 10 minutes, until 3 o'clock, if you don't mind. Okay, let's continue. Please write down. Do you see me? Do you hear me? Do you see the slides? Yeah, sure. Thank you very much. So if you have any questions, please write down into the chat. I will cover all of the questions afterwards, after the lecture, or if we have time during the lecture. But nevertheless, all of your questions will be covered. So therefore, let's go on. So what is the forward contract's payoff? Let's break down the payoff structure of forward contracts actually. For example, for a long position, here on the graph, you can see the following. The payoff here is ST minus K, where ST is the spot price at maturity, and K means the delivery price or the execution price. So in simpler terms, if you are long a forward, then it means that you are hoping the spot prices will be higher than the delivery price at maturity, for example. If it is, you've made a profit. Conversely, for a short position, the payoff will be opposite, K minus ST. And here you are probably hoping the spot price will be lower than the delivery price at maturity. So, and this graph on the right visually represents the profit structure for a long forward position, actually. And you have to notice here how the profit line intersects the x-axis at point K, which is the delivery price. So here, any spot price above K at maturity results in a profit, as you can understand, while any price below K results in a loss. And here the relationship is always linear for the forwards, but not for the other instruments. And that means usually that each dollar change in the spot price translates directly to a dollar change in a profit or loss. So this linear payoff in general is both a strength and weakness of forwards. For example, it provides perfect hedging against price movements, but it also means you can't benefit from favorable price movements beyond the locked-in price. So, for example, we can consider a scenario where an airline says locks in fuel prices with a long forward contract. If oil prices skyrocket, so they are protected actually. But if prices plummet, so they miss out on their savings. It's therefore it's a trade-off between certainty and potential upside. So let's talk about the futures contract, which are very similar to the forwards but different. So moving to the future contract, so we can see they share similarities with forwards, but have some differences. For sure, first of all, futures are standardized and traded on exchanges. And that brings actually both advantages and limitations of these instruments. So on the one hand, the standardization of futures contracts is crucial, and it specifies exactly what can be delivered, where, when, and in what quantity, for example. And this standardization makes futures more liquid and easier to trade than forwards. One unique aspect actually of futures is its daily settlement or making to market. This usually means gains and losses are calculated and paid out daily, which can affect cash flow and margin requirements as well. So a fascinating aspect of futures contracts is how they converge to the spot price as we approach the delivery date, for example. So this convergence is driven by arbitrage opportunities, usually. For example, if the futures price is above the spot price near expiration, then traders can short the futures, buy the asset, for example, and make delivery for risk-free profit. Now, this arbitrage usually actively pushes the futures price down towards the spot price. See, as you can see on the left graph. And the reverse happens if the futures price is below the spot price, actually, where traders buy futures and, for example, sell the asset. Again, by means of that, they make a risk-free profit. They may make a risk-free profit by means of that. So this convergence is usually crucial for the effectiveness of futures as a hedging tool. And usually without that, hedgers couldn't rely on futures prices to accurately reflect, for example, expected spot prices at maturity. These graphs on the slide visually demonstrate the convergence we just discussed. And I would like to stress your attention on that, how the futures price and spot price lines meet at the delivery date. And that is, once again, that is very important in terms of hedging. So the left graph here shows a situation where futures prices start above spot prices, perhaps due to expectations of rising prices or storage costs, maybe. And the right graph shows the opposite scenario. But in reality, this convergence isn't always smooth because, for example, I've seen cases where last-minute supply or demand shocks can cause rapid price movements just before expiration. Okay, let's go on. What about options? Options are the other wonderful instruments in terms of the risk management. So let's move to the world of options, therefore. So options really offer a different kind of flexibility compared to forwards and compared to futures. For example, a call option may give you, or if you're a buyer, may give you the right, but not the obligation to buy an asset at a certain price, which is usually called a strike price, by a certain date. So, but the put option is the opposite. So this is right to sell without obligation as well. And this optionality is usually incredibly powerful. Why? Because it allows the holder to benefit from favorable risk movements while, for example, limiting downside risk to the premium paid. For example, a company considering an overseas expansion might buy currency, call options, to protect against potential exchange rate increases without committing to the expansion. So here the distinction between American and European options is really crucial to understand. For example, American options can be exercised at any time during their life, while European options can only be exercised at maturity. And this difference in exercise time and can significantly affect option prices actually, and even option strategy as well. For example, American options are generally more valuable due to their greater flexibility. But it's interesting that most, for example, exchange-traded options are American, with index options being a notable exception. For example, except of S&P 100. The option for S&P 100 is usually European. And the ability to exercise early can be really valuable, actually, but it also complicates the decision-making process. For example, I've seen many traders struggle with whether to exercise early, to hold on, hoping for greater gains. So about options positions payoff. Let's break up the payoffs for different option positions, because it is really crucial if you manage your market risk by means of the options hedging. For example, for a long call, the payoff is maximum between spot price minus expiration price and zero. Yeah, and a long put payoff is usually maximum between expiration price and spot price and zero. We have to notice how this provides asymmetric exposure, for example. And short positions here are simply reverse these payoffs. For example, capping potential gains, but exposing to the right to potentially large losses. So there are concepts of moneyness as well in terms of in relation to the options. So and moneyness is really a key concept in options trading. Because it indicates the relative position of the current price to the strike price of the option. For example, if an option is in the money or ITM, it would have positive value if exercised immediately. Yeah, and if the option out of the money or OTM, then it would have zero value if exercised immediately. And at the money options or ATM usually have a strike price very close, not equal, but very close to the current market price. For example, for call options, if spot price larger than expiration price, that it means that it is in the money mode. Yeah. If spot price is less than expiration price, it means that it's out of the money. And for puts, it's opposite. So if spot price is less than expiration, then the option is in the money. And otherwise, if spot price is more than expiration, then the option is out of the money. But in both cases, if spot price equals expiration price, then either a call option or a put option are in the money, are at the money. So I would focus your attention on that moneyness significantly actually affects an option's sensitivity to various factors like price changes and time decay, for example. So let us consider an example of the long call on eBay. So, and this graph that you can see on the slide illustrates the profit profile for a long call option on the Bay stock. So we have to notice here the asymmetric payoff. For example, losses are limited to the premium paid, while potential gains are theoretically unlimited. And the break-even point is at the strike price plus the premium paid, for example. And we should notice that asymmetry here makes long calls attractive for speculators betting on price increases, for example. And long calls are usually useful for creating synthetic long positions where the risk is rather defined, which can be valuable, for example, in volatile markets. And what for the short call on eBay? So this profile is opposite to the previous ones. So the payoff here is essentially a mirror image of the long call, and it is really limited potential gain and theoretical unlimited loss. So, and the maximum profit here is the premium received, which achieved actually when or if the option expires out of the money. So, and this risk profile actually makes short calls popular for, say, income generation strategies, like, for example, covered calls. So let us consider the other examples of hedging. So let's walk through these kind of examples. For example, we have a physical oil delivery at $50 per barrel, and we simultaneously sell an oil futures contract at $55 per barrel. And here, if the oil price drops to $50 at delivery, then we lose $5 on the physical delivery, but gain $5 on the futures contract. And here, this hedge is sometimes called perfect hedge. So it results in a net financial impact of zero, for example, effectively locking in our prices. But in reality, perfect hedges are rare due to factors like, say, basis risk. But this example nevertheless illustrates the fundamental principle of hedging. So one more thing about hedging. So let us look at the different types of hedging strategies across various desks in the, say, financial institution. But all industrial companies or trading companies or exporters or importers, they do hedging as well. Not only the financial institutions, but these kind of industrial companies, they make hedging through financial institutions usually. So here on the slide, you can see that the equity desk focuses on hedging price volatility usually, and often uses option strategies. The commodities desk typically hedges price fluctuations using futures and options, and the rates desk manages interest rate risk usually through duration management and gap analysis. The forex desk usually deals with currency volatility using, say, a mix of forwards, options, and spot transactions. And for example, in my experience, say, effective risk management requires a holistic view across all of these desks, as risks can often be interconnected for sure. So another hedging example, practical example here, you can see practical example of hedging an equity position using options. So for example, we have an investor with 1,000 Microsoft shares, currently worth, let's say, $28 each. So they buy put options with their strike price or expiration price at $27.5 per contract. See, for $1 contract. And the total cost of this hedging strategy will be $1,000 which means 10 contracts, for example, of 100 shares for the contract of $1 premium. Overall, this strategy guarantees a minimum sale price of $27.5 per share of the Microsoft shares, and with the less than $1 premium paid. So this type of hedge actually is very popular among investors who say want to protect against downside risk while, for example, retain an upside potential. So therefore, based on the previous example, let's analyze the outcomes of our Microsoft share hedging strategy. So, for example, if the stock price falls below 27.5, then the investor can exercise the puts, effectively selling, for example, at 27.5 or at 26.5. It doesn't matter after accounting for the premium paid. And if the price stays above 27.5, then it means the options expire worthless. But the investor here retains the higher stock value. And this asymmetric payoff is why many investors prefer options for hedging over futures or forwards, for example. But it's important to note, finally, that this protection comes at a cost. That means that the option premium matters, because it's always should be reminded that we have to consider here the cost-benefit trade-off, deciding whether to hedge by means of options or not. So, and this graph visually compares the value of the Microsoft share holding with or without our put option hedge. So you have to notice how the hedged position has a floor value. Yeah, the floor value. This is a continuous line. While the unhedged position, which is a spotted line, can potentially fall to zero. And that is the meaning of the hedging. So the trade-off is that the hedge position underperforms slightly when prices, for example, are high due to the cost of the put options. And the visual representation often helps counterparties understand the risk-reward trade-off of hedging strategies here. But in practice, I would say that the choice between hedged and unhedged positions depends on the investor's risk tolerance and market outlook. Okay, let's go on with the reasons for hedging and an equity portfolio. Usually, there might be two main reasons why investors might choose to hedge an entire equity portfolio. First, it can be a cost-effective way to temporarily reduce market exposure without selling the portfolio. And second, hedging can help manage systematic risk while retaining exposure to stock-specific performance. And this second point is particularly relevant for active managers who believe they can, for example, outperform the market. But in my experience, therefore, the decision to hedge often depends on market conditions and the manager's confidence on their stock price. So hedging an individual stock is similar to hedging a portfolio, but with some important differences. So the main challenge here is that stock-specific hedging only addresses systematic risk, not the unsystematic risk, which is unique to the stock. And this actually means that the hedge will be imperfect, especially for stocks with a low correlation to the market. But in practice, I found that using options, for example, on the individual stock can be more effective than even index-based hedges for managing stock-specific risk. Yeah, and however, liquidity and cost considerations here also often make index hedges more practical for larger portfolios, because it is cost-effective. So we have come to the next question.
which is based on the previous slides. So a company wants to hedge its exposure to potential price increases in a commodity. It needs to purchase in 6 months. Which of the following derivative instruments would be most appropriate for this purpose? So please select one of the 4 answers, and only one answer is correct. So as you guess, and we will discuss it afterwards. So let's take, say, 3 minutes for that. Okay, I can see your answers. Yeah, the second answer is right, actually. A long position on a call option. So why? Let us explain. Because a long call option gives the company the right, but not the obligation, as you know, to buy the commodity, for example, at a predetermined price or a strike price in the future. And this usually protects against price increases while allowing the company to benefit if prices fall, for example. And it usually provides asymmetric payoff, limiting downside risk to the premium which was paid while retaining upside potential. And therefore, the second answer is right. So we have come up actually to the practical part of the lecture. So, and I will please let me take several minutes to prepare myself for the practical task, and I will explain what we will do. Okay, do you see the table? It is blank. Do you hear me well? Great. Okay, let us go through the example calculations of the value at risk. Then we will do it from the scratch, and afterwards I will provide you with a file, with the appropriate file to let you do it by yourself, actually. So I will comment on I will do it from the scratch, actually, just for you to better understand how the process works. And therefore, I will comment each step. If you have any questions, please write in the chat. So the first step for the calculation of value at risk, we have to collect the data, really. So therefore, here in Microsoft, in Excel, there is a very good function which is called stock history. So, for example, let us take say Microsoft stock as an example. We have to enter the name or a ticker of the stock, and then we can put in the function together the stock prices. For example, I have a predefined function here. You can see the function stock history. So which, sorry, not the proper cell. So the predefined function actually that applies to this equity ticker, Microsoft, you can see here with the reference to the cell. Then goes the parameter of the start date. So we have to download, say, 250 quotes or close prices usually for this function. And you can see here the description of the function. So it's a standard function of the Excel, and I guess you can use it as well. So we have to set up the start date. Then we have to set up the end date. So then we have to set up the interval, and you can see here that there are different digital numbers for the different intervals. For example, if we would like, by means of this approach, to calculate daily value at risk, so we have to choose daily, therefore 0. If we would like to calculate, for example, a weekly at 10 days value at risk, we have to select 1. So, and headers, this is a technical parameter just to show up or not to show the headers. So we would like to have them in the table. Therefore, we push enter button, and here we get all of the quotes for the Microsoft equity for the given period of time, starting the year 2024, ending today. So, for example, or yesterday. So then we have to download the quotes, for example, for the next equity, which we need to compare to the valuation, to the value tree in terms of the value at risk to the Microsoft equity. Let's say it might be, for example, Apple. So we have actually the same function, but with the a little bit different parameters. So here we reference to the to another cell, which contains the name of the, not the name, the ticker of the equity. So that is an error in the cell. I will change it. So, but we download just close price without date. So, or nevertheless, it recognized. Yeah, no, it seems to me that the ticker is something the following. Yes. So we have downloaded actually the Apple prices for the same period of time. Then, in order to calculate value at risk, we will have to calculate changes in the price. Yeah. How can we do that? So here will be the change. For example, we can do it the following way. There are different means of calculation of the changes. For example, we can do it the following way. Say for Microsoft. So we can compare two prices -1. So here will be the change. We can change it into the percentage format. Yeah, that's it. So the change for 1 day of the price of Microsoft was 0.1%. So, and we have do the following, the same for Apple equities. So, and you can see the change was much bigger. So we have to spread it until the end of the period of time. Therefore, yeah, that's it. So, and you can see that they may, the prices may change differently. And the volume of change, or an average volume of change, is usually defined by the volatility. The volatility, what is it? Let's calculate it for the both equities. So here, so let's consider the first Microsoft share. I have a predefined function, which is standard deviation. So the volatility usually is measured by the standard deviation, and there is the appropriate function in Excel. So we can measure it in percentage as well. So it's and we can measure in percent. Therefore, so the standard deviation is 1.2 for the Microsoft, and it's 1.5 for Apple. What does it mean? So the standard deviation usually means, as you may remember, the difference between an average an average outcome, or the average change of the equity price and its average, overall average throughout all of the time period we consider. So what does it mean in terms of these functions? So it usually means that Microsoft is on a daily time period is a little bit riskier than vice versa. So the Apple price is a little bit riskier than Microsoft price, actually, because on average, the volatility of Apple is bigger. So the changes are bigger for Apple. So then we have to calculate value at risk for the both equities here. So in order to do that, we have to define several parameters, as you may remember. For example, we have to define horizon, evaluation horizon, or period, for example, in days. Moreover, we have downloaded actually the daily data. Therefore, we can preferably use this data for the daily calculations of VAR. So for we have to define confidence level, and we have to calculate value at risk. First of all, we will calculate it on the base of parametric and historical for both equities. So here you can see I have preset the parameters for the calculation. So the period of days will be 1, and confidence level will be 0.95, which is very common, as you may remember. And we, as you may remember, we may calculate the value at risk by means of a very simple formula. For example, the formula is here. So if we take into account the confidence level of 0.95, then we have to set up the percentile of the standard deviation of the standard normal distribution or Gaussian distribution as 1.65. This is a predefined value of the percentile for this given confidence level, actually. Then, so we put in here minus, as it is loss. So this percentile must be multiplied by the volatility ratio we have estimated before, and it has to be multiplied by the square of the time horizon. So this is an upscaling of the measure. So we can upscale it to the different periods of time, comparing to the opposite to the historical valuation, which is not so easy as for the parametric value at risk. So, for example, in percentile, we can have for about 2% evaluation of value at risk with a confidence level of 95. For example, if we increase the period of time, for example, 10 days, so we will have 6.5. So I would pay your attention that it is not multiplied 10 times. Yeah, it is multiplied square of 10. Therefore, the increase of the value at risk will be less. So, and therefore, what does it mean? That means that according to this estimation, we will not lose. So our maximal loss with the confidence level of 95, which is not, I should focus your attention, which is not 100%. We will not lose more than 6.5% derived from the current price of the equity. So we can leave 1 day, for example. So, and if we would like to change the confidence level, so in this example, we should do it manually, but nevertheless, there are tools much more automated. So we have to change the percentile of the estimation to 2.33. So, and it will be, as you can see, bigger than the previous one. Therefore, we should notice. Do you hear me? Yeah, it's okay. Yeah, it's okay. Thank you. So, as you can see here, the value of the value at risk is bigger for the bigger confidence level, and therefore it might be logically explained. So the bigger confidence level, the bigger the valuation. That means that for the one-day trade, we should not lose more than 2.9% of the current price, or of the current value of our equity position. And as for historical simulation, it is rather different in terms of the calculation, but it may be, it's not actually, it does not have actually calculation requirements according to a much bigger calculation requirements, intensive maybe, according to the function, predefined function in Excel that we can use. So, and it is called percentile. So in the previous versions of Excel, it's simply percentile, but in the last version of Excel, it may be percentile inc, for example. So here we should point our data range, not the price range, but the changes data range for the appropriate equity. And then we have to point out the parameter K, which is percentile, and which usually means 1 minus confidence level. So we can calculate it very quickly. And what we can see that the value at risk for this equity is bigger for the historical simulation of value at risk than for the parametric or variance covariance value at risk. So it's not bigger too much, but we can see that our hypothesis of the underestimation of the value at risk of the maximal loss, for example, for the parametric value at risk, actually makes sense. So the historical valuation due to the fat tails of the distribution of the real historical distribution of the price change is bigger. And therefore, if we make, for example, increase the period of days, for example, take not 1 but 10 days as a price and horizon, so the difference will be bigger, I guess. So, and let's do the same for Apple, for example, price. I have predefined the calculations here. So you can see that for Apple, due to the higher volatility, here the value at risk is bigger than for the Microsoft as well, according to the parametric value at risk. And here you can see the historical valuation that is actually less. So, and that is a difference because of that, we cannot definitely say that, for example, which of the methods underestimate or overestimate the risk. But we use preferably, for example, the second method, the second approach, historical simulation. For example, if we're sure that the crisis will not happen in the next days, for example, or during the period of evaluation. So if we are sure that during the 1 day, in that case, the crisis will not occur, then it's good to use historical valuation as it measures it measures the value at risk on the fair basis. Yeah, and here for the Apple, we can see that in opposite to the Microsoft parametric value at risk, the value at risk, parametric value at risk for Apple, it overestimates the maximal loss for the Apple position comparing to the value at risk for the historical simulation. So the norm S in for norm. Yes, sure. You're quite right. So any other questions on that?